Okay, I made a little tweak here to the non-operating assets, so it'll be right on the one that you get. It's just a little bit off from what I have. I also noticed one other thing that I'll be changing, so just stay with me on this. So what happens is the non-operating assets is the next piece we need to look at. So if I go to the case, you'll notice, and this is in Exhibit 5, they have the investment in affiliated entities of 157.7. Okay, so now that's going to be the value that's booked on my books. At this point, what I try to impress upon students is we have to be a little skeptical of that value because it's based on equity method of accounting. So it's basically a result of some journal entries where we put it on our books for what we pay for the investment. We increase it for our share of their net income, and then we decrease it for when we receive dividends, which is not going to give us a good estimate of market value. What we'd like to do is value that based on a DCF, but we may or may not have access to that. So in this case, in the case, what we're going to do is we're going to use a market multiple based on that. Now, we could do it a couple different ways. One way we could do it is you'll notice that they have this market value of equity. So I could just do sum and then just have that market value of equity. And then I have, I could also look at I don't know where the net income's at. I thought it was around here somewhere. They've got net income. And I think the net income ends up giving us like something like a 30 multiple. So take the total value of the market value of the equity, and maybe it's better to show you here. I'll go to the last slide here. So you could add this all up, and then you could divide it by the net income, and that would give you sort of a approximately 30 value to income or earnings multiple, which is fine. If they want to use something like that, that's totally okay. It seems inflated to me. A better thing to use, I think, and they say somewhere here in the case, some of the information in the footnotes is useful in this case. Trying to see where we have this. Oh, here we go. Historic PE multiple for the industry is approximately 19. So I would recommend that, I'm going to just use 19. Again, whether that's realistic or not, I don't know, but we'll just use 19 because I think it gives us a little bit more reasonable number. Now, what happens is students need to now apply this to the earnings, which if we go to the income statement here, you'll see that the earnings are 90. Now, that's on a pre-tax basis. So what I think is prudent here is to take that 90 and then multiply it by 1 minus t, or 1 minus the tax rate. So you'll notice here what I do is I take 90 times 1 minus the 40% tax rate times a 19 multiple. And it'll end up giving us something like, I can't remember. Let me just get rid of these two. So we'll see, and then I'll just undo it. So it ends up getting us like 1026, something like that. So now I'll put back in the cash and marketable securities, but that's the total value of the non-operating assets. Now, whether or not they will actually do that, and you'll notice I've even changed this slightly from I had this calculation in here. I just used 19. It's slightly different, so that's why I'm getting 1026 and then 996. And at one time, I swear they've changed this calculation because it used to give us a more reasonable multiple. So I'm not quite sure what's going on, but this is kind of the process that they have to go through. So don't use that, but use something that's based on the multiple. Now, whether or not they use 30 or 19 or something like that, or if they use pre or post tax, I'm not that worried about this. I just want to see the attempt. I would definitely take a half point off if all they use is 157.7, because they clearly didn't even make an attempt to try to get that number. So just FYI. But definitely don't get too worried about wrong multiple or if it's pre or post tax, because I get that that's a subtlety they may not have gotten. Then they subtract, so then they get the total value of the enterprise. Then they take out debt. Then they take out minority interest. Now, the minority interest, what we could do is we could take, again, here I'm kind of going to make an adjustment on the fly. I notice I haven't changed it in this spreadsheet, but I changed it in my other one. This should really be a similar approach to what they did with the investments. So now the minority interest, this is what's on the books. So if I go look at the books, they subtract in the balance sheet, they subtract out 43.4. Now this is, how this comes about is you bought another company, but you haven't fully purchased them. So maybe you own 95% of them. So you consolidate them with your results, but then that you have to show that you don't own the whole thing. Now this is a result of book value journal entries. So we want to make an attempt to kind of put a market value on that. So what you can do is you could use their share of the earnings and again apply a price earnings multiple. Again, we'll apply that same 19 times to that 15.1. So if I go over here now and I take equals 15.1 times 19, I would now get a value of like 5606. Now again, I don't want to, again, I don't know that they'll necessarily get this or not. If they don't, it's not the end of the world as far as I'm concerned. But it is a point that I try to make. So if they just do 43.4, then I would just leave it alone. If they forget to subtract the minority interest, I would just take a half a point off to say, oh, you should have got the minority interest. So overall, then we end up with about a 5606 equity value based on that. Now, if I go back to the questions, so obviously they got to come up with some estimate of the discount rate. I think that's actually where are we at here. Yeah, the discount rate for the unlevered cash flows explain the methodology. They come up with the estimated the long-term growth rate. Just calculate a terminal value using your long-term growth rate. What's the present value, the going concern value? That's probably just the present value of the terminal value. So I actually don't like that wording in hindsight. So and then just put an overall value on Airthread. So as long as it looks like they're doing things reasonable, I think I would just be happy to just make sure that they're not doing anything major wrong. Obviously, if they misapplied a terminal value, that would be like a half a point. But overall, make sure they write up a good paper. That's probably worth half a point or a full point depending on how they did. But again, I'm happy with a median that's around 19 if that's what we end up with. I think they ought to do reasonably well with this. Let's not hang them too bad on the long-term growth rate calculation. I just want to see an attempt. Again, I don't necessarily have to have the right value of the long-term investment, but I don't want to just put in 157.7. That's not appropriate either. They also have to remember to add back cash and the marketable securities off the balance sheet as of 2007. So overall, I think it should be a good, shouldn't be too bad from a grading perspective. But any questions, just let me know.